I'm Shae Russell for mining.com.au, and joining me today is Rick Rule, who humbly calls himself a private speculator. But really, Rick, you don't need any introduction. Rick, how are you today? It's so good to see you again.
Life is very good. The better, in fact, Shae, for being on air with you. Thank you.
I am thrilled to have you back on. I have now recovered from both my hangover and my incredibly long time it took me to go see you in Boca Raton, Florida this year for the Rural Investment Symposium. That took a little bit, but I don't want to talk about my travel woes. I actually want to talk about some of the things that are happening in the market today. And I guess most recently is this market meltdown that we've seen in the past 2 hours. Listen, there's a few moving elements to it, but have you sort of got a view here on what happened that you can share with everybody?
Well, I guess a couple views. I think it's interesting that people are surprised for the first thing. I'm not, as you know, a real doomster, but I do look at trends in motion and talk about probabilities. So let's talk about the Japanese carry trade first. 40 years of excessive government spending, 40 years of debt and deficits, and 40 years of fostering exports through weakening the currency with artificially low interest rates, allowing the banks to reflate their own balance sheet by subsidizing them, allowing them to borrow cheaply in yen with a low interest rate that presupposes that the currency will go down, while allowing them to buy higher yield U.S. securities where the currency might go up. Is it a surprise that when you begin to unwind that, the Japanese banks decline by 30% in price? Probably not. The thing that's interesting is that investors look at narratives where the narrative hasn't been proven by price action, and they ignore it. Shae, you remember talking to me in 2022 when I said to you, the uranium price at $20 a pound is unsustainable because it costs the world $60 a pound to make the stuff. You make it for 60, you sell it for 20, try and make it up on volume because you're a dumb miner, and sooner or later you have a problem. This was apparent to everybody, but nobody wanted to buy uranium until it had already gone up to $80. The circumstance that we see with the Japanese carry trade and the circumstance that we see with uranium are the same. The signposts are there, and people ignore them until they come to pass. When they come to pass, the price action makes the narrative much more believable.
Okay, so some of these major indices have bounced back up. Is this really just an overreaction from the markets to the unwinding of the dollar yen carry trade?
I think not, but I think we've seen the most dramatic part of it. Remember, Shae, at least with regards to the American market, and in particular the American treasury market, that prices aren't set across the whole spectrum of buys and sells. They're set against the margin. And if the marginal buyer goes away, then the price declines. The most important foreign buyer of U.S. treasuries in the absence of China, which has been largely absent for 5 or 6 years, has been the Japanese as a consequence of the carry trade. The marginal non-U.S. buyers of U.S. treasuries has gone away, which is going to be, I think, maybe not a catastrophe, but certainly a challenge for the U.S. Treasury market, which is the largest securities market in the world by a country mile. It may also impact other markets like the U.S. equities market. But I think the place that's concerning in the next 12 to 14 months will be the U.S. Treasury market.
I just want to shift gears just a smidge and bring it back to sort of mining and metals. Now, I noticed in Australia, and I'm probably about to be caught out here because I didn't check the US market, but in the market meltdown that we've just seen, the mining index, our ASX 300 metals and mining index, didn't fall as hard as the broader Australian market. Tell me, is that reason to be slightly optimistic for miners, or was this mostly people just dumping speculative tech stocks?
I'm not as familiar with the other components of the Australian market as I am the US market. I think that the expectation of success around the US technology market was so extraordinary that there were a lot of people who owned tech stocks without a sense of its value. They owned it for the momentum. And I think, too, a lot of people own tech stocks on margin. The expectation in the North American market for success in the mining business was nil. And so there was no success premium built into the stocks. And not very many people decided to own them on margin. Very few people were that dumb. So my suspicion is if there were sectors in Australia that were as extended as the US tech sector did, that they, of course, would have been hit harder than miners. The beauty, I would suggest, of at least the senior part of the Australian market, the Australian mining market, is that the share prices are underpinned by free cash flow. There are circumstances where you have a market crash or a flash crash that's liquidity driven. In that circumstance, everything falls because the sell decision isn't made by the investor, it's made by the margin clerk. But those companies which have an underpinning of value generally recover more quickly. And I would suggest that the Australian mining majors and super majors, trading with enterprise value to EBIT at 5 times or 6 times or 7 times, were much less extended than the US technology sector, with enterprise values at 30 and 40 and 50 times EBIT. And the consequence of that is not having inflated so much, they didn't disinflate quite so badly.
That is an excellent answer. And I'm going to stick on the technology aspect for just 1 minute and how it relates to mining. Now, we're seeing the rise of artificial intelligence being used across the exploration sector and in obviously when mines are up and running through the use of virtual reality in, how companies work with people across different sites. But just bringing it back to exploration for the moment, how is AI going to change exploration, or are we being a little bit ambitious with this?
I think the answer is some of both. I don't think that there is a substitute for boot leather and the human eye. But I think that you can deploy both more intelligently with technology. I remember 20 years ago seeing the application of astroimagery, taking pictures of 2,000 square kilometers from space, looking at the spectral differentiation, and looking for surface alteration from space. And using coincident anomalies, looking as an example at geological structures from space that were so large and perhaps so subtle that you couldn't see them on Earth. Now, that didn't make a discovery, but what it did was it allowed you to focus that boot leather, those human beings, on 2 or 3 square kilometers out of a 2,000 kilometer data set so that you could employ that boot leather more intelligently. I've seen a couple really pretty miraculous displays of target generation using AI because AI seems to have the ability, after the information has been digitized, at synthesizing a bunch of different types of data, overlaying the data on each other, and doing what desk explorationists do, which is coincident anomaly analysis, measuring structure, measuring geophysics, measuring surface mapping, and looking to target by coincident anomalies. Then focusing traditional expertise with a much better application of talent, rather, as I say, than exploring 2,000 square kilometers, exploring 2 square kilometers using, of course, traditional methodology.
All right, now dominating the mining market at the moment is the annual Diggers and Dealers Conference here in Australia. I know you're laughing because you've had some good times there, I'm sure.
I have.
Now, it's sort of one of the ongoing jokes in mining markets in Australia is that, if you're not at Diggers, who are you? So unfortunately, I didn't get to Diggers this year, so I clearly don't count. But I know you have been. I'm going to get to one of your favorite memories of Diggers in a moment. But first of all, we need to be serious. And there are 3 key commodities that are being talked about at Diggers at the moment. And the first 2 are copper and gold. They seem to be reoccurring themes according to our journo on the ground there. My question to you is, I've been talking about gold and copper and the importance of it for half a decade. It feels a little old hat to me. Tell me, is this because I was ahead of the curve, or it's because these metals are that important that we need to keep having these conversations?
Some of both, and a third factor. Diggers and Dealers, if you're an exhibitor or if you're a speaker, is all about raising money. And Diggers and Dealers took a holiday from copper and gold. and went into lithium and rare earths and a bunch of stuff, nickel. There were a bunch of topics at Diggers and Dealers that were easier to raise money around. Those themes have disappointed, and in some cases disappointed mightily. So the theme comes back to raising money. I mean, copper and gold. Uh, and I think that's really what you're seeing. I think it's important to note, too, that, gold is always going to be a good sub theme in Western Australia. When I first started attending Diggers and Dealers, probably coincident with your birth, Shae, they produced about 1 million ounces of gold in town in Kalgoorlie. It truly was a gold-centric conference because the whole town, well, ran on beer sales at the Palace, and other than that, it ran on gold. But I think the renewed focus on gold and copper has to do with the fact that in the Australian market, you can still raise money around gold and copper. And there is at least more hope among the punters around gold and copper than there is, as an example, around nickel or PGMs or, heaven forbid, lithium. Whatever, I suspect, gives people the least discomfort, or in a better market, the most comfort, will be what is talked about at Diggers. I happen to believe that Diggers is probably more rational this year, talking about gold, where I think there's a good outlook, talking about copper, where I think there's a great outlook, and the market is soft, a wonderful circumstance, and of course, talking about uranium, which I think has structural attractions that no other commodity has.
I am so glad you closed on uranium because that's exactly where we're going next. And I don't have to do some hard segue into it. So, our opposition leader in government flew into Diggers and Dealers yesterday to talk about uranium and nuclear energy within WA. Now, obviously, he's preaching to the choir here, and there is definitely a political angle. But we've touched on this before about embracing uranium. Is that really the best way to do it, to win over a mining crowd that's already most likely pro-nuclear energy?
I don't think he was trying to win over the crowd. I think he was sucking for campaign contribution. Um, if they were trying to win over the crowd, they would have had skimpies cheering uranium, uranium, uranium. I remember a provincial politician in British Columbia coming and delivering a red meat speech to a mining crowd, and he wasn't trying to convince anybody. There was a campaign coming up, and he was trying to fill the till. He was, in fact, an unpaid exhibitor, if you think about it. Australian uranium policy has always amused me. The three mines policy, as an example. Why three? Just out of curiosity. Your country has an incredible endowment around uranium. And the traditional Labor Party should, I think, be attracted to high-paying, high-skills jobs. They should be attracted to the export of intellectual capital from Australia, rather than making high earners leave Australia and pay tax somewhere else. The unconventional left might be attracted to the idea that you could lower utility bills for poor people in other places. That seems charitable to me. And they might be attracted, too, to the carbon-free nature of baseload power from uranium. The idea that they can conjure up some opposition to it is astonishing. Now, they say, of course, that there are dangers to uranium, not understanding that the fly ash piles from burning coal generate more background radiation than every nuclear power plant in the United States. We say in the United States, more people died in Ted Kennedy's car than have died in nuclear power plants in the United States, when we're dealing with our left. So it really does mystify me. The joking aside, the anti-uranium narrative wears thin. I understand that there are consequences to pay when mistakes were made. But if we were trying to avoid mistakes, we wouldn't allow people to drive. We wouldn't allow them to fly. We wouldn't allow them to vote because they cause wars. So where does it stop? You know, it, I guess that's my whole point. It's difficult for me to understand the anti-power generation stance exhibited by some parts of the Australian political spectrum. It's difficult for me to understand the anti-production. I can understand perfectly the local opposition to Jabiluka because all the rents went to the center. Canberra got all the money, and the Aboriginals got the shaft. Nothing particular unusual about that in politics. So the local opposition probably can be dealt with a more equitable sharing of the social benefit, of the social rent. Should Canberra really be concerned about the Aboriginal rights, they should loosen up the purse strings with regards to the money they extort from mining and leave more of it in local hands. That doesn't seem to occur to politicians on either the right or the left.
Listen, Rick, your knowledge of Australian geology, mines, and government surpasses almost any international person I have ever spoken to. So I want to really localize that knowledge with this next question and take it right back to diggers and dealers. By the way, thank you for shaving a decade off my age before when you said it probably started around the year I was born. I'll take that compliment. All right. I know you've talked about your experience with Palladian just recently in an interview we did, and how you met John Borshoff, and that was how you became an investor in that company. What I want to know now is, with diggers and dealers and probably a few sore heads this morning, what is your favorite publishable memory of diggers and dealers?
I guess my favorite conference memory in Australia isn't Diggers. It was appearing at a conference hosted by our mutual friend Carrie Stevenson when she arranged for me to be interviewed by the ABC. I had not one, but two bottles of beer somehow. And the cameraman said, "That's okay. Put them in your pocket. We'll do a headshot." And then proceeded to interview me with both bottles of beer, very obvious for a national Australian audience. Miraculously, that did a lot for my reputation in Australia. He unknowingly did me a lot of favors among Australians for fairly obvious reasons. The thing that really astonished me about Diggers and Dealers, and it's the memory that I will always take from it, is despite the romp, the only conference in the world where they begin serving alcohol in booths to attract attendees after lunch. I've never seen anything like that in my life. The combination of frivolity and absolutely incredible technological knowledge has been always astonishing to me. I watch people show up in the morning that should be in hospital and actually impart truly, truly spectacular knowledge. When you look at and I haven't been for a couple of years, but when you look at the antics that go on at night, and then you look at what gets accomplished during the day, it is truly an astonishing circumstance. Now, as a 71-year-old male, are there parts about the historical, political, and social incorrectness of Diggers and Dealers that I miss? Absolutely. Absolutely. I won't go into all of them, but it was a hilarious time. It was good for me to have been there 35 years ago as opposed to now, probably for those reasons. But the truth is also that there has been a uniformly high level of technical competence at that conference, not usually on display after 6 p.m. Uh, but it has really, really, really been of high caliber. I also need to say, in the early days, I may have been the only Yank that went.
Yes.
And there were two things there. One, I made a lot of money at Diggers and Dealers. I mean, I made a lot of money at Diggers and Dealers. And when I started going in the early part of the decade of the 90s and the latter part of the decade of the 80s, there was no money at all in Australian markets. None. And the fact that there was a fresh check writer, better yet, an American, unschooled in Australian ways, Well, I knew how a very pretty girl in a very tight skirt felt walking down the aisles. I had no trouble talking to anybody. I had trouble shrugging people. And the consequence of the fact that stuff was so cheap and nobody cared, and I did care, and I represented a reasonable sum of money, meant that Diggers was truly spectacularly profitable for me in those days.
One day we'll see if we can coax you back to Diggers. And I have heard some of the glory days and the war stories of the activities after 6 p.m. It's apparently not as wild as it used to be when you were first there. Now, as you pointed out at Diggers and Dealers, it's very much about attracting money. I get approached quite a bit about how private placements work when it comes to mining companies because there's a lot of high net worth investors that very much want to get a seat at this table. Now, this might sound like a bit of a commercial, but I know that there's a lot of people interested. I know you've got sort of a boot camp coming up. Can you talk me through what to expect? And then I'm going to send a link to my mates.
Well, thank you for the opportunity. As you know, Shae, once every 3 months, we work up the energy to do an 8 hour long deep dive on one subject or another around natural resource investing. We've done uranium, we've done silver, we've done prospect generators and exploration, we've done royalty and streaming. Now we're doing a boot camp around private placements. Uh, Private placement investing has been very, very, very good to me, Shae, over 50 years. I've learned a lot about it. This product, this boot camp, will be 8 hours long, and I need to tell people ahead of time that this is not an entertainment product. We're going to work you very, very hard for 8 hours. There are going to be parts of it that are technical. There are going to be parts of it that are boring, but you're going to learn a lot. The recordings of the boot camp will be available for a year, and I would suggest that to be successful, you'll have to play all or part of them 3 or 4 times because the amount of information that we give you in 8 hours is more than you're going to be able to absorb in 8 hours. We are going to talk practically about private placements. We're going to talk about what to look out for, what to look for, how to structure them, when to say no, how to say yes. We're going to talk about private company private placements, investing in private companies that never go public. We're going to talk about pre-public private placements. We're going to talk about the fact that IPO is usually an acronym for it's probably overpriced. We are going to talk about public investment or private investment in public offerings, which is to say pipes. We're going to talk a lot about debt private placements and a lot about convertible preferreds. They're less well known, and I suspect more attractive on a risk to reward basis. We're going to talk about timing in private placements. We're going to talk about warrants. Yes, we're going to talk extensively about Australian private placements, gold card investments, which are investments for non-Australian participants in Australian private placements. But we're also going to talk about AIM private placements, American private placements, and Canadian private placements. We will cover the waterfront, I would suggest, with mining and oil and gas investments privately.
So you took away my next question, which was, yeah, but is there really any benefit for Australian investors? This is great. So this sounds like it's got a real global focus to it. Now, for everybody listening, I will share the link with you. I'll pop the link in the description of today's video. Rick, before we close out today, any final mining market thoughts that you might want to share?
Well, one that we've talked about before, Shae, which is to say a different way of describing a bear market is a sale. People seem to be intelligent when they buy physical goods. When somebody goes to the store and tuna fish are on sale, they substitute tuna fish for canned salmon or for chicken. When they go to buy a winter coat, they're delighted to see the coat marked down 50%. For some reason, people want to pay up for financial assets. I can understand why a 50% off sale on a stock that you own is problematic, but the truth is you have a choice between being a contrarian or being a victim. If you liked it for $1, you better love it at 50 cents, or you better know you made a big mistake at $1. Um, I can't say this often enough. The money that's made in investments is made on the delta between price and value. And if you haven't done the work to understand the value, the price information is of no use to you. Buffett says famously, you shouldn't buy a share if you wouldn't be delighted to see it fall 30% in price in the next month so you could buy more cheaply. Now, Shae Sedley, I've tested that thesis dozens of times in my career, but it turns out, in fact, to be true. If you've already done the work to establish the value and the price gets cheaper, that's a good thing, not a bad thing. So I would encourage people to look at volatility as frequent sales. And I would encourage people to look at catastrophic declines, not the kind that we've just seen. I mean catastrophic declines, 2008 style declines, as once in a decade sales. Keep some powder dry, work on your knowledge, and have the guts to pull the trigger when everybody else is running for the exits. Similarly, if you've been lucky enough to buy uranium stocks in 2022 when nobody owned them, and they're up 500%, and everybody's complimenting you for as being a genius, don't be too greedy not to sell. You haven't made the money if you haven't taken the money. When the world is on the sell side, be on the buy side. When the world is on the buy side, be on the sell side. Sounds simple, tough to do. Take it from me. If you occasionally get it right, it works.
Rick, this has been a fantastic conversation today. I have to say I've thoroughly enjoyed it. Listen, thank you so much for being here. I know it's your afternoon and the sun's still out, so I'm going to let you get back to it. Thanks again.
I will do it. Before I do it, I would invite your listeners to go to ruralinvestmentmedia.com and list your natural resource stocks. I will, for no obligation and no charge, rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments have some value. If you've enjoyed my macro thinking, maybe you'll enjoy my micro thinking, confined to your own stocks.
I will also pop a link to that in the description of today's video. I will just let everybody know I personally have run this gauntlet. And if you mention some explorers Rick hasn't heard of, I suggest you review those explorers you've got in your portfolio. Rick, thank you so much for being here. This is great. I look forward to next time.
Always a pleasure. And thank you for your support of our conference this year. It was great having you there and seeing you there. And thank you for the gauntlet you ran getting there and home.
Yeah, it was a bit intense.